In 1992, an American businessman, George Soros, made $1 billion in a single day from the stock market. He did this by betting on UK currency, claiming that it would dramatically fall in the coming weeks. As his prediction came true, Soros became the man who broke the Bank of England. But in his mind, this bet was available for years. Now, it feels astonishing to notice how billionaires like them earn millions of dollars from the stock market while the rest of the world is still running to pay their bills. So, how was the stock market invented? If we dive deep into the history of the stock market, then traces of it can be found in the 13th century. During that time, various banks in Venice began trading in government securities. Soon, other Italian cities like Pisa, Florence, and Verona followed the same practice. However, it was only in the year 1602 when the Dutch East India Company established the first joint stock company in the world. The brainchild of the leading statesman of the Dutch Republic, Johann van. The objective behind this incorporation was to increase their profit by trading in spices from the Maluku Islands of Indonesia. But due to a lack of funds, they decided to provide shares of their company to the Dutch residents so that they could raise more capital and expand their spice trading business. And people, in return, were allowed to buy and sell their shares in an open secondary market, which today has become the Amsterdam Stock Exchange. Although for the next century, the stock market was still struggling to catch people's attention, a massive boom was witnessed when, in 1792, 24 brokers signed the Buttonwood Agreement in New York. An agreement in which these brokers pledged to charge 0.25% commission from clients for every sale and purchase of public stock. As brokers began chasing clients for commission, the largest stock exchange in the world was born. The New York Stock Exchange, whose market capitalization is now $26 trillion, which is equal to the stock exchanges of Shanghai, Europe, Japan, the UK, and Canada combined. But how does the stock market work? And how would you know what is the best time to buy and sell a share? To understand this picture, let's take the example of Apple Company, which is listed on the New York Stock Exchange. Now, imagine you have $10,000 in the Bank of America. As of today, this bank is paying you an interest rate of 0.01% on a savings account. But if you park the same money in Apple shares, you could get the opportunity to gain 30 to 80% more on $10,000. Specifically speaking, in 2019, the single share price of Apple was $37, but in 2020, it suddenly jumped to $73. So if you had invested $10,000 in Apple in 2019, you could have almost doubled your money in just 1 year. The reason behind the sudden increase in Apple's share price is also connected with the pandemic in 2019. As the world was put to a halt, the majority of Apple investors believed that Apple would not be able to cope with the worldwide lockdown. So they began selling Apple shares and brought its price from $40 in 2018 to $37 in 2019. However, those who were aware of how Apple was operating their business refused to sell Apple shares and took advantage of the price difference when it reached $73. But as amazing as it looks, there are also serious risks involved. Because if you look at it from a different picture, buying Apple shares can also land you in severe debt. For example, if you had purchased Apple shares in 2021, then holding them for a year was not a great idea. Because in 2021, Apple's share price was $175, but in 2022, it was $129, which means a loss of 26% on the money you invested. And despite waiting for the entire year, you had no other option than to watch Apple's share price fall on television. The reason behind this fall in share price was connected with supply chain issues from China. Due to the zero COVID policy followed by President Xi Jinping, Apple's biggest supplier, Foxconn, failed to operate on full scale in China. As a result, Apple lost around $6 billion in sales from supply chain issues. So, you have to stay updated about the company when you're investing in the stock market. Luckily, more power is now granted in the hands of people after the rise of the internet in the last 2 decades. With stock trading apps like Interactive Brokers or TD Ameritrade, you can simply log in and analyze the stock price of your favorite companies in real time. Although people also follow the latest advice from stock leaders like Warren Buffett, there is nothing better than understanding the share price on your own. The more you understand and read the stock chart of a company, the more confidence you will develop over time, thus saving you from losses and allowing you to gain profit on time. So, what are your views on the stock market?